Okay, let's dive into this. Welcome to this explainer, where we are going to tackle one of the most misunderstood topics out there, building wealth. Most people look at successful investors and assume, wow, they must have had a massive salary, some kind of secret insider knowledge, or they just stumbled into a really lucky opportunity. But in reality, wealth creation is almost always the result of simple, fundamental principles applied consistently over many years. In this explainer, we're going to walk through a complete, step-by-step financial architect blueprint. Because whether you're starting with $100 or $10,000, the rules of the game remain exactly the same. We're going to show you how to construct a realistic, long-term investment strategy from the absolute ground up. So, here is the blueprint we'll be following today. First, understanding true wealth. Second, building a solid foundation. Third, the compound growth engine. Fourth, managing risk and diversification. And finally, number 5, avoiding common investing mistakes. Let's get right to it.
Part 1. Understanding true wealth, moving beyond income. Before we can build wealth, we have to actually understand what it is, and honestly, what it isn't. We need to debunk the single biggest myth holding most people back. Now, what's really interesting here is the clear line drawn between the pouring faucet of what you earn and the deeply rooted tree of what you actually keep. Income is just the money flowing into your bank account from your job or your business, right? It pays the bills. But wealth is entirely different. Wealth is not determined solely by how much money you earn, it's determined by how effectively your money works for you. You can have a sky-high income, absolutely massive, but if you spend every single penny of it, your wealth is zero. Literally zero. True wealth is the portfolio of assets you accumulate that generate value completely independent of your daily labor. Now, you might be wondering, well, great, I'll just save a portion of my income in a bank account and call it a day. But saving alone is simply not enough. Why? Because of a silent wealth killer called inflation. To put that into perspective, a dollar saved in a mattress 20 years ago has lost nearly half its purchasing power today. Half! If you just leave your cash sitting in a basic savings account, inflation is slowly, quietly eating away at it. To actually grow your wealth, you have to outpace inflation, and you do that through the historical growth of diversified investments. Investing isn't some luxury reserved for the elite, it's an absolute necessity for long-term financial survival.
Moving on to Part 2, building a solid foundation, the architect's first step. Just like you would never frame a house on top of loose dirt, you absolutely cannot start investing without pouring solid financial concrete first. Let's look at this workflow. I know, it might seem unsexy, but it is absolutely vital. Step 1 is emergency reserves. Before you invest a single dime in the market, you need a cash cushion to handle life's inevitable surprises. We're talking a car repair, a medical bill, a sudden job loss. Step 2, managing debt. High-interest debt, like credit cards, will drain your wealth faster than any investment can ever grow it. You simply have to tackle that first. And Step 3, setting financial goals. Are you investing for retirement, a house, maybe your kid's education? Knowing your destination determines the vehicle you take to get there. This quote perfectly captures the mindset of a successful financial architect. Investing should not begin with chasing returns, it should begin with building a stable financial foundation. It requires serious financial discipline. Setting up automated budgeting systems and really being honest with yourself about your risk tolerance. If you skip this step and go straight to chasing hot stocks, well, you're basically building a house of cards that will collapse the moment the wind blows.
Part 3. The compound growth engine, time as an asset.
Okay, this is where the blueprint gets incredibly exciting. If you take away just one concept from this entire explainer, make it this one: compound growth. It's the process of earning returns on your original investment and then earning returns on those returns. Think of it like a giant snowball rolling down a hill. At first, it's pretty small, right? It gathers snow slowly. But as it gets bigger, its surface area increases and it packs on snow at an exponentially faster rate. But to make this work, you need the right mindset. You have to reinvest your returns rather than spending them. You have to let the snowball roll. Let's look at the raw mathematical power of this curve. If you invest just $500 a month over 10 years, you've built a nice little nest egg. But notice the explosive jump at the 20-year mark? The growth curve starts to bend upwards dramatically. And by the 30-year milestone, the vast majority of your portfolio's value isn't even the $500 contributions you made, it's the compound growth doing the heavy lifting for you. The growth literally accelerates as time goes on. It's almost like magic, but it's just math. This snowball effect triggers what I call the massive aha moment of investing. Look at the difference here between investor A, who starts at age 25, and investor B, who waits until age 35 to start. Even if investor B invests significantly more money every single month than investor A will almost always end up with a larger portfolio by retirement. Why? Because time is the single most valuable asset an investor has. No question. That 10-year head start impacts long-term outcomes more than almost any other factor. So start early, even if it's a really small amount. Part 4. Managing risk and diversification, weatherproofing your portfolio. So, you've started the compound growth engine. Awesome. Now we have to play defense. And I want to be very clear here, and it's important to approach this with a calm, rational mindset. The stock market will go down. There will be recessions. There will be volatility. It is completely normal. The reality is, risk cannot be eliminated completely, but it doesn't need to be. It just needs to be managed. Proper diversification and disciplined decision-making allow you to ride out the storms without derailing your long-term plans. And this brilliantly illustrates exactly how you manage that risk. You don't put all your money into one company or even one sector of the economy. You spread your capital across different asset classes. By holding a mix of domestic stocks, bonds, and international exposure, often through broad market index funds, you avoid concentration risk. If one sector takes a massive hit, the others can help balance out your portfolio. You are literally weatherproofing your wealth against individual failures. It's a real game changer. Part 5. Avoiding common investing mistakes, behavioral traps. You can have the perfect foundation and a beautifully diversified portfolio, but human psychology can still destroy your entire plan. Let's rapid fire through these behavioral traps because they happen every single day. Emotional investing, letting fear or greed dictate your actions. Panic selling, watching the news headlines scream about a market crash and selling your assets at the absolute bottom. Trying to time the market, thinking you can perfectly guess when to buy low and sell high. Spoiler alert here, almost no one can do this consistently. Following social media hype, buying a stock just because someone with a rocket ship emoji tweeted about it, lack of diversification. And finally, short-term thinking. Reacting to scary news or chasing get-rich-quick hype almost always leads to catastrophic and costly mistakes. Remember, investing is a marathon, not a sprint.
Conclusion and action plan. Your long-term strategy.
We've covered a massive amount of ground today, so let's distill this into a framework you can actually use right now. So the crucial point is this 5-step strategy. 1. Build a financial foundation with an emergency fund and manageable debt. 2. Invest consistently, putting money to work every single month regardless of what the market is doing. 3. Diversify appropriately so a single failure doesn't wipe you out. 4. Think long-term, letting the magic of compound growth do the heavy lifting over decades. And 5. Stay disciplined, especially when the market gets rocky and those behavioral traps look really tempting.
Successful investing is rarely about finding that one perfect golden investment. More often, it's about doing the boring things right, day after day, year after year. As our final quote states, and I really want you to let this sink in, the goal is not to get rich quickly, the goal is to build sustainable wealth patiently and intelligently. Following proven principles consistently over time is what separates those who just dream of wealth from those who actually build it. So I'll leave you with this final thought to carry with you. Knowing all this is great, but execution is the whole shebang. It's what actually matters. Ask yourself right now, what step will you take today to start building your financial foundation? Will you review your budget? Will you open that brokerage account? Will you finally tackle that high-interest debt? The clock of compound growth is ticking, and the best time to start was yesterday. The second best time is right now. Thanks for joining me on this explainer, and happy building.